We're seeing green on the screen today. I think there was a lot of jitters earlier this week about whether or not we would get to this point coming after those Nvidia earnings. There's a lot of people, Guy Johnson included, who are looking for the moment that the bubble pops. If you're one of those people, how easy is it to short the market right now?
Well, so I presented at Iverson yesterday and I dropped a long. And so some people asked me, are you done with short selling? No. But I would much rather be long than be short in this market, I think is the terse answer there. Look, if you're out there trying to short Nvidia or any of these big tech names, you're not going to be in business very long. So when I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as Nvidia are still going up and to the right, I think that would be a very dangerous trade. So, yeah, we have a list of names that we think are suspect, and when the time is right and some of the froth is out of the leaders in this space, that's when we're going to look at them. But until that point, we're staying out of those waters. You said until the froth comes out of some of the leaders in the space. What is the canary in the coal mine that suggests that froth will come out? Yeah, actually, I want to rephrase that a little bit, because I think the way this will kind of end is that you'll have an oversupply of speculative assets. Right? It'll eventually crush the demand for speculative assets. So we see these cycles periodically. We saw this at the end of 2020 going into the beginning of 2021. I mean, it was so bad, that's when you had these, almost valueless stocks that were ripping. And so what happened was Wall Street responded by producing a lot more financial product. And you had all these de-SPAC transactions, and that just collapsed the demand. So I think that's what's going to happen. So it likely won't be Nvidia that starts cratering, but it's going to be all the wannabe AI, wannabe tech names. There just will be too many of them, and it will overwhelm speculative demand. And then that can start to sink or, cause a little bit of suction for the leaders in the space.
Good morning, Carson. I wonder, we've talked about AI and as in what it's doing to the overall market, but I wonder what it does to your business, to the identification of short candidates, for example. I know I've heard you talk earlier this year about how maybe it doesn't help identify them that much, but I wonder how much that conversation is evolving, because you mentioned, maybe there'll be companies that overstate the benefits that AI might bring to their business because it's very zeitgeisty, it's very trendy right now, and when the tide goes out, might be the time to start identifying those. I mean, is AI useful to you in trying to identify the companies that have overhyped AI?
Well, we are still not using it to identify, but what is helpful, definitely uploading a bunch of documents, and if this isn't super important, saying, okay, create a summary and then sending that around. So large language models are helpful for that. And I say large language models because I'm not a tech person, but some years ago, somebody explained to me how a large language model worked. And they said, this is not artificial intelligence. This is not actually thinking. And so I'm on a chat group in Austin with some people who are very big in the venture and tech space. And I asked them this question last week. I said, okay, when you look at all of these CapEx plans for, AI data centers, what portion of this is for large language models versus other forms of, quote, AI? And nobody can answer the question. And so I think that's actually what's very interesting, because my understanding is that large language models are unlikely to evolve to the point where they can actually be smarter or, nearly as smart as a human. Whereas there are other types of AI models that could be evolved to that point. So as far as large language models go, they're great for parsing large amounts of information and creating summaries, but they haven't helped us with pattern recognition up to this point.
Okay, so that's not where you get your ideas from. From what you said there, then, you do think that maybe we've overhyped. I mean, are we going to see businesses? There's talk of businesses using, agentic AI agents to help them do things more productively. This is the big productivity secret, big productivity gift waiting for us over the next 5 years or so. We've got aging populations globally. Is that to hope too much? It's not going to be that way.
Well, certainly there's some functions that these seem to perform reasonably well. I mean, they're not 100% accurate. And I do think that large language models, if we want to talk about high-value knowledge industries, I do think that they are coming for the legal industry in a big way. I mean, just when you think of how much of law is reviewing documents and trying to distill them and synthesize those documents, large language models don't understand what they're reviewing. And to date, I mean, there are a number of lawyers who've gotten in trouble for relying on them, but they will probably, I assume they will get better at that and they will stop hallucinating cases. So the legal services profession, they really do need to watch out.
I was talking to the CEO of a large bank in Europe the other day, talking about the kind of the mechanical process of passive money coming into the market and how the market's become terrible at valuing things. Can you value? Is this marks out of 10 for this market valuing things just because of that flow, that passive flow story?
Well, look, I absolutely believe that passive has broken the markets in terms of greatly diminishing price discovery. And there was a very interesting paper written 2 or 3 years ago by some academics. It's called the inelastic market hypothesis. So they say, look, this classical theory of finance that when stocks become too expensive, people make rational decisions and reallocate to bonds, that's broken. That doesn't hold. And so they estimate that with the U.S. market, that every net dollar that flows into the U.S. market, in aggregate, market cap increases by $5. And so that demand for stocks is inelastic to price. Like the higher they go, again, classical finance.
So the market is irrational.
So the market is, well, I mean, you could look at it and say it's irrational, but if you understand what passive is doing, and by shrinking the supply of stocks, by constricting that, because it doesn't matter how expensive Nvidia gets, right? All of these funds that are buying the S&P 500 index, they will not sell Nvidia until they have net outflows. So they will buy it every day at whatever the price is if they have inflows. So up to a point, passive has a role in the markets. But now passive is becoming the market when you look at a lot of the major indices. And that's why you also see all this dispersion in the indices, right? So if you look at it in a given year, you know, roughly 2/3 of the companies in an index are underperforming the aggregate performance of the index, which is being driven by a small number of companies. And that concentration is just one of the offshoots of the passive phenomenon.
Let's go from kind of macro to the very micro. You talked yesterday about Snowline.
Yes.
Do you like Snowline because it's a gold company, or do you like Snowline because it's going to get bought?
Well, okay, so it can be both, right?
Okay.
Both things can be true.
Try and get a choice.
So, look, the reason that we got interested in mining a few years ago, our macro thesis has nothing to do with the price of metals. It's that for a couple of decades, there's been an underallocation of human talent to the mining sector. That's on the operating side as well as the investment side. So we feel that especially in junior mining, there's real edge because there are not a lot of investors out there who actually understand the dynamics there and know how to look at these companies. So when we look at Snowline, as we call it, is a true tier 1 freak deposit. Majors, regardless of the metals, they have to acquire because they've stopped doing greenfield exploration. Their exploration budgets are focused on their existing deposits, trying to find adjacent deposits. So majors are devouring themselves because they're producing and removing any terminal value that they would otherwise have. So they have to acquire companies like Snowline. In the gold mining industry, Snowline is the only deposit that we're aware of that can move the needle for a mid or major miner at this point. So yes, we think it gets bought, and the dynamics in gold are such because, again, the majors are depleting their reserves that they have to acquire companies like Snowline.
Carson, I know we just went really micro. I'm going to macro it out again as a final question to you. You said a couple of things in Guy's passive investment question. You kind of indicated there is kind of a buyer of last resort to some extent, which brings me nicely to the Federal Reserve. You mentioned the SPAC collapse in a couple years ago. It felt like what popped that speculative bubble was higher rates coming down the pike very, very quickly. If we start to see that again from the Federal Reserve, is that what pops the bubble? Or to what extent is this rally being driven by the Fed greasing the wheels?
Well, so, I mean, my take, the the rates went up in the second half of 22. And I think, GameStop was really the peak, the end of January of 21. It was really the peak of the highly speculative stocks. So it was kind of funny because in 22, when I would do the rounds, people would say, oh, this must be a great year for you because the S&P was off, because that responded to rates. In the bread and butter world of most short sellers, where we're in small and in mid-cap stocks, 21 was a great year. 22 was kind of meh as a result because so much of the air had come out of it. So I think that when we're looking at things that are interesting for us to short, not beta hedges, but alpha shorts, I think that's just going to be caused by the imbalance between, supply of speculative names and demand for them. But, what happens with rates, that's going to have much more of an impact on your large cap. So for the few short sellers that are still out there, basically trying to do alpha shorts in that space, which I don't know why you would, that's, that'll matter more to them than it does to the few of us who are still doing shorts elsewhere.